Welcome to part 3 of the Investing Derivatives video, and in this segment I'm going to talk about how you can hedge your portfolio using futures contracts. The reason why I decided to put this as the last segment is because it borrows from several concepts that I mentioned in part 2, more specifically the shorting of futures contracts, where you earn a profit when the prices of the underlying shares are falling. Let me now define the concept of hedging. Hedging is basically a strategy that investors use to try and minimize the losses on their portfolio. And how can you hedge using futures contracts? So let's assume an investor has shares of Safaricom and KCB, and he has some worries that we're going to have a decline in the prices of these shares. What can he do to hedge his portfolio? What he's going to do is he's going to go to the futures market and take a short position on the futures contracts of the equivalent stocks that he has. What do I mean by this? If he holds Safaricom and KCB shares, he's going to short Safaricom futures, at the same time also short KCB futures. This means that the losses he's getting in the spot market are offset by the profits or rather the gains that he's going to get in the futures market. Let's now look at the concept of hedging using a practical example. Let's assume one investor owns 1,000 shares of Safaricom and 3,000 shares of KCB. The price of Safaricom is currently at 13 Kenyan shillings, while KCB's share price is at 20 Kenyan shillings. So his stock portfolio will be currently valued at Safaricom, that's 13, the price, times number of shares, 1,000. So that's 13,000 Kenyan shillings, while KCB's value will be 20, that's the price, times 3,000, which is the number of shares, hence 60, you get a value of 60,000 Kenyan shillings. Hence, the total value of his stock portfolio is 13,000 plus 60,000, which gives us a total of 73,000 Kenyan shillings. However, he's concerned that the share prices of both companies are going to fall in the next few days. After a few days, his fears become a reality and the share price of Safaricom fell to 11 Kenyan shillings, while KCB's share price fell to 18 Kenyan shillings. His stock portfolio is now valued at, so for Safaricom will be 11, that's the price, times 1,000, the number of shares. So that's 11,000 Kenyan shillings, which means that he has lost 2,000 Kenyan shillings on Safaricom, while KCB is now valued at 18, that's the price, times 3,000, the number of shares, giving us a value of 54,000 Kenyan shillings. This means that he has lost 6,000 Kenyan shillings on KCB. Hence, his portfolio is now valued at 11,000 plus 54,000, giving us a total value of 65,000 Kenyan shillings. This means that his stock portfolio is now worth 8,000 Kenyan shillings less, or rather he has lost 8,000 Kenyan shillings. He still doesn't want to sell his shares and incur the losses because he believes that both companies are good companies and they will recover at some point. So what could he have done to make sure that he minimized his losses at the moment where he started having fears that the share price of these companies were going to decline? Let's have a look at how he could have used futures contracts to hedge his portfolio. If you can remember, his stock portfolio was initially valued at 73,000 Kenyan shillings. To hedge this portfolio in the futures market, he needed to take a short position on the equivalent single stock futures of the same value as that of his stock portfolio. This means that when the price of Safaricom and KCB fall, he gets a profit in the futures market, which offsets the loss on the stock portfolio. Let's have a look. So for Safaricom, his Safaricom shares are worth 13,000 Kenyan shillings. Hence, he needs to pick up 21st of December Safaricom futures worth the same amount, that's 13,000 Kenyan shillings. So from the calculations we did, that's in part 2 of the video, when determining the value of one futures contract of Safaricom, we get the value by multiplying the price, that's 13, times the number of contracts, that's 1, times the underlying shares, which is 1,000, so we get 13,000. This means that he only needs to short one futures contract of Safaricom to hedge his Safaricom holdings. Remember, he'll not have to deposit the entire 13,000 to pick up this contract. He'll only be required to have the margin amount plus trading fees around 2,552 Kenyan shillings. For KCB, his KCB shares are worth 60,000 Kenyan shillings. Hence, he needs to pick up 21st of December KCB futures worth 60,000 Kenyan shillings. From the calculations we did in part 2 of the video, when determining the value of one futures contract of KCB, we calculated the price, that's 20 times the number of contracts, that's 1, times 1,000, the underlying shares. So the value of one futures contract of KCB is 20,000 Kenyan shillings. This means that he needs to short 3 futures contracts of KCB to hedge his KCB holdings. And also remember, he'll not have to deposit the entire 60,000 to pick up 3 contracts. He will only be required to have the margin amount plus trading fees, around 5,382 Kenyan shillings. Let's now see how this works. Keep in mind that the price of Safaricom fell to 11 Kenyan shillings, while KCB's share price fell to 18 Kenyan shillings. So he took a short on one contract of the 21st of December 2023 Safaricom futures. Let's calculate his profit. So the profit is calculated as the difference, or rather the price change, that's 13 minus 11 times 1, that's the number of contracts, times 1,000. You get a profit of 2,000 Kenyan shillings. While he also took a short on 3 contracts of the 21st of December 2023 KCB futures. So his profit will be calculated as 20 minus 18, that's the price change, times 3, that's the number of contracts, times 1,000, hence getting a profit of 6,000 Kenyan shillings. Hence his total profit is 2,000 plus 6,000, where we get a total profit of 8,000 Kenyan shillings. This means that the profit of 8,000 Kenyan shillings in the futures market now offsets the loss of 8,000 Kenyan shillings he had on his stock portfolio. I hope you now understand how you can hedge your stock portfolio using futures contracts available in our local derivatives market. Stay tuned for part 4 of this video, where we're going to have a practical session where I'm going to show you how to trade derivatives online using the trading platform called Aveto.